How's it going, friends and family? Well, you already know what time it is. It's time for another portfolio roast session. And today, I'm going to be a little delulu and crazy because I am Carlos. And together, we're going to be taking a look at my portfolio to see what improvements we can make and if it's coherent and sound with the strategy that I have right now. So I know the face is a little Asian, but after my operations and surgery, what you see on the left side of your screen, that's what I will look like. I'm 31, I'm Carlos. I currently work in an Amazon fulfillment center. I started out on the picking team at minimum wage, working nights. Yes, friends and family, 36 hours a week, breaking my back to make sure that you can get your toilet paper delivered to your front door. And I eventually worked my way up the ladder, and now I'm an area manager for the outbound side. So, pretty crazy story, and I started investing about a year and a half, roughly 2 years ago. And by the way, this right here, let me go snap back to reality. Oops, there goes gravity. I got my Tdap vaccine yesterday. Dude, I'm just like, I'm out of it. I have flu-like symptoms, so prior to filming this video, I took Dayquil. Hopefully it starts kicking in, but if you feel like the energy is not there, it's because I'm feeling the effects of the Tdap vaccine. Now, with my background story out of the way, let's talk about the portfolio. What you see on your screen right now is the portfolio itself, the strategy. I'm doing dividend growth investing with downside protection. So instead of only going for hyper growth, like most people would insinuate and suggest for a 31-year-old, I'm going for modest gains during the good and the bad times. Because I understand that if you only go for hyper growth, you're also going to have to go for the belly down roller coaster ride portion. It goes both ways, right? And my goal right now is to achieve at least 10% CAGR, compound annual growth rate, when you take the share price appreciation of the holdings within the portfolio plus the dividends paid out year over year, 10%. And to have reduced bleeding during pullbacks and corrections, as I just alluded to. And I'm currently in the capital accumulation phase of my working years. And here's the cool thing. I actually dollar cost average with every single paycheck that I get from Amazon every 2 weeks. And if I scroll down, you could take a look at the 16 holdings that make up my portfolio. There's Apple all the way down to Walmart. And I'm investing into some riskier names for short-term growth. I understand they're not the best quality compounders out here, but they're so beat up that I'm investing into them. And then once they pop 20, 30, 40%, I'm out of there. I'm going to sell for a profit, and then I'm going to pivot into more stable dividend stocks that we all know and love on the channel. And the current situation at the time of filming this video, it's September 24th, about 2 p.m. here in Japan. I usually film in the mornings, but dude, when I woke up this morning, I literally thought I was dying. My entire face was congested. I had a fever, body aches, but I don't think anyone cares about my condition and my health. So the value of the portfolio is $37,000. And of that, I invested $31,400. So pretty good. Not bad for a year and a half in the stock market, and the current portfolio dividend yield is 1.7%. However, my yield on cost makes it a little better, 2.07%, because I bought into the stocks while they were at their 1-year low, and as they went up in share price appreciation, their dividend yield on paper went down, but my yield on cost is 2%, and every year right now I can expect about $651 in dividends, which I would argue is not too shabby. So taking a look at the shares a little closer, if I break it down to see which ones have the biggest weighting, Realty Income Corporation currently comprises about 12.8% of the portfolio. Right after him in second place, we have IBM, an ancient tech company who has now pivoted into the AI tip of the spear with their cloud endeavors and whatnot. The smallest position that I have is currently Amazon. And I guess a little above him, his big brother is Waste Management, and then Cheniere Energy. So on a very high level, what are my thoughts and opinions of my own portfolio? Well, I think this is a pretty solid hybrid approach to investing. There's a little bit of everything, right? We have growth represented in Google, in Apple, and ASML. We also have income players like, where's Realty Income Corporation? Realty Income Corporation. We also have Pepsi, and we have turnaround plays like PayPal. And there's even Disney represented, which, hey, this is a magical experience so far, right? I think the drugs are kicking in. I mean, the medicine, the Dayquil, starting to feel a little bit better. My head is a little cloudy, so I'm not as quick thinking today, but for all things considered, not too bad. So instead of going gung-ho in one school philosophy of investing, such as only income investing or just growth, we got a little bit of everything. And if we take a look at the portfolio broken down, the analysis, take a look at the dividends, right? Realty Income Corporation, if he was not a part of this portfolio, I would be screwed because he comprises about 40% of the $651 in dividends paid out, because Realty Income is responsible for about $261, which I would argue is pretty good. And remember how we talked about with my strategy, I'm trying to protect my portfolio during the bad times? Well, let's see if that actually pans out. So if we scroll on down to the metrics tab right here, by the way, I'm using a website called Snowball Analytics. I do have a referral link down below that'll give you 10% off. I think it's pretty neat because it makes your portfolio holdings visually appealing, but it also gives you an analysis such as what we're looking at right here. The portfolio volatility relative to the market. So the S&P 500 would be right there as a standard of 1. My portfolio is slightly below it, which means my volatility is not as bad during the down swings. Likewise, it's manifested in the Sharpe ratio and the Sortino's ratio. So the volatility of my portfolio when things go south, not too bad. And the overall PE, I know some of you might be like, this is way too expensive, but it's a 33.7 on average. Right now, the S&P 500, you can fact check me, it's around a 30. So as a general rule of nipple, my portfolio has more expectations baked in because the PE, the trading multiple as a congregate, is a little higher. So the expectations are up here. And if we jump on back over to the growth, remember, I want a 10% CAGR year over year, or to at least be in line with the market. Is that what we're achieving? So my portfolio is represented by the blue line, the S&P 500, otherwise known as the benchmark, the standard, aka the market. Well, they're a yellow or gold, depending on if you have color blindness. And I would argue it's pretty much like this in a race, toe to toe. I mean, sometimes my portfolio beats the S&P 500, but other times, like since August, I think the S&P 500 is slightly outperforming me. But for the most part, we're performing about the same, and it makes sense because when you look at my holdings, I mean, it's the S&P 500. We got Apple, we got Amazon, we have Google, MasterCard, Realty Income. Yeah, so to be honest, this portfolio, I like it. I like what I see for the most part. I like that there's dividend compounders represented because one of my fears is as I conduct the Roast My Portfolio series, seeing a portfolio that's only made up of cigarette butt stocks. Stocks that are beaten up, but they're not undervalued. They're cheap for a good reason because they're all ugly. That's one of my fears. But friends and family, in the case of Carlos today, I would argue there's probably only 1 or 2 ugly ones in here, but the rest, not too bad. So we have dividend compounders represented, which I would argue are probably the best type of investments in the stock market because not only are they going to compound your wealth, but you also get a dividend payout. Number 2, I would argue it also has some of the better dividend income stocks like Realty Income, Pepsi, United Health. And number 3, I'm going to be completely transparent with you. Prior to making this video, I had never heard of the Cheniere Energy company. It's a natural gas midstream player in the oil and gas field, and it's probably because I fat-fingered the Cheniere Energy into my brokerage app. I truly meant to put the Centene Corporation, which is a Medicare Advantage health insurance stock. But hey, Cheniere, not doing too bad. Overall, I'm up by 12.6%. I'll take it. Now here's the thing about Cheniere. Their fundamentals are a little rough, but their stock market performance is absolutely bananas. I'll show you. 1 year back, 30% into the green, and this is just the share price appreciation. Now I'm on a website called stockanalysis.com. It's my preferred website to do all of my research for stocks. Once again, I have a referral link down below that's 10% off on top of whatever promo or discount they've got going on their website. We do 5 years out, 366%. talking about your money 4xing in the span of 5 years, we can go ahead and say that Cheniere Energy is definitely a compounder. What kind of makes me puzzled is, as I took a look at their numbers, dude, this is kind of volatile. Wouldn't you agree? Because oil and gas companies are cyclical. They have highs and lows. It's a boom and bust type of industry. Obviously, they reached the high in 2022, $33.3 billion of gross sales. Pretty good. I mean, you can't argue that's not fantastic. However, since then, it fell off a cliff, right? It dropped down to 19.7 billion and then 15.4 billion, and then it's back up. So for me to see their stock price ballooning up the way it is, I'm baffled. Because the fundamentals for this company is just, it's not very attractive. I mean, back in 2015, they were unprofitable as an enterprise. During the pandemic, we'll give them a pass. I think a lot of companies were suffering and struggling. So I'm not going to judge them too hard in 2020. But in 2021, come on. Negative $9.25 of profits per share. That's what the EPS stands for. Not good. And then in 2023, it ballooned up to $40.72. Dude, no matter how you spin it or manipulate it, that's absolutely phenomenal. So do you get why I say that the oil and gas field as a whole, a generalization, is that it's a boom and bust type of industry? When the times are good, it's really freaking good. $40 of profits per share, bottom line per share, pretty darn amazing. However, the bust is pretty bad as well, because their EPS, their bottom line per share, dropped by 65% year over year, and then it dropped again by 9.3% year over year. So the fundamentals are not there, but it doesn't matter because the stock market seemingly loves Cheniere Energy. If we jump on over to their, I guess balance sheet would be fair, because I assume they have a lot of CapEx for the nature of their work. But if we take a look at their free cash flow, I mean, what we want to see is something that is predictably going up and to the right. But in the case of Cheniere Energy, I mean, it was pretty bad in 2015, right? Negative 7.3 billion, atrocious. I would not want to go near this stock, but it is going in the right trend up until 2022. They reached $8.6 billion of free cash flow. That means after funding the operations, what's the actual cash going into their pockets? Not with cooking the books or an accounting manipulation way, which is the income statement, because you can have a cash loss that's not your cash leaving the company. It's just writing down the valuation of an asset. Oh, I bought this for $1 billion, but now we're saying it's $200 million. Oh, we lost $800 million, but you didn't really lose the cash. Does that make sense? The cash is not leaving your pockets. Whereas the free cash flow tells you what actual cash is generated from the operations. But I digress, just in case you already know what the free cash flow is. The trend for it to be declining year over year, not good. So it doesn't really make sense to me why this stock right now is at an all-time high. It's bananas. And then another holding where I'm kind of puzzled, but I understand, is AutoZone. Currently trading for about $4,120 a share. Year to date, 28% into the green. I understand this holding, like the investing thesis. Less people are more inclined to buy a used car or a new car because the prices are just absolutely bonkers. It's so freaking expensive. You tell me why a 2005 Honda Odyssey with 300,000 miles goes for 10 grand. It should never be 10 grand. If that's you on Facebook Marketplace, shame on you. But anyways, the investing thesis is this: because the car prices and the valuation is just all jacked up, more people are going to be dispositioned to hold on to their vehicle longer than usual. And to do that, you're going to have to do maintenance and repairs. Coming into the picture is going to be AutoZone. I think there's also like Advance Auto Parts, O'Reilly's, and then another one. These are retail stores that sell car parts. Do you need a car filter? Do you need to change a socket? Or do you need a fresh brake pad? Whatever it is, you go to these stores and you buy it, and then you can do a DIY repair or take it to a mechanic that you trust, a little garage that has graffiti all over the walls, but he doesn't charge you an arm and a leg to fix your car. So AutoZone, I get the investing thesis. It's not a business operation that I'm entirely in love with. I think it makes sense in the short term, I mean, given their performance, it makes a lot of sense. 3x your money in 5 years, 253%. It makes sense. But I think going forward, I mean, this might be unpopular because when I think about modern technology and cars these days, dude, it's no longer 1960. It's not 1971 where the transmission goes out before 40,000 miles. I mean, it might if you buy a Jeep or Ford, but for the most part, Hyundai, Toyota, Tesla, these cars can go like 200, 300, 400,000 miles. And the general problems per capita, I think it's reduced from decades ago. I mean, you're still gonna have issues. You're still gonna have the regular maintenance stuff you gotta do, like oil changes every 5 to 7,000 miles. I think the biggest lie in the industry is doing it every 3,000. That's overkill. 5,000, 7,000, you're in the sweet spot, you'll still be okay. I guess all that to say, if you want a good brand reputation as a car manufacturer, you want to build something that is quality and something that lasts. Because the last thing you need is for your customers to be dissatisfied with you because you're known for having car issues, for having transmission issues, engine problems. So I think as the quality of modern cars improve, I think the likelihood of doing repairs is reduced. And on the other hand, I'm not going to say that I'm bullish about the EV industry, but a lot of the states in the US, I mean, I've been researching for fun, and it seems like states like California, Washington, Oregon, they're making the deliberate push towards EV and clean energy vehicles, which, as you know, have less maintenance and moving parts in terms of like fluids and liquids to get the car moving. But I mean, their financials, it makes sense. Every single year it goes up without fail. There's growth happening in the gross sales. Their bottom line per share is funny money, $144.87 of profits per share. I've never seen it that high ever before on this channel. Like, that is absolutely bizarre. I hate to be that guy. If I had to invest into something in the car space, which I would prefer not to, if I had to, I'd go with Tesla. It's not that I feel really bullish about the quality of their cars. I don't own a Tesla myself, but I think it's the whole idea of investing into the only publicly traded company that's associated with Elon Musk. Because I know Elon has a lot of fanboys out here. Me, I don't really think too fondly of him. I'm just neutral. I don't hate him. I don't like him. I'm just like, all right, whatever. He's a CEO of multiple companies. And I think if you want to invest into Elon, I think one modality is through Tesla, you know, with solar panels and his cars. And apparently in the EV space, it's best in class. However, I just read an article like yesterday or 2 days ago that said Chinese BYD, which is also an EV manufacturer, they're now outpacing sales in Europe while up against Tesla. So I guess we'll see what happens in that race. But hey, 1 year, 78% in the green, sign me up. 200%, roughly 3xing your money, not bad at all. But the thing that I don't like about Tesla and why I don't invest into them, out of the Mag 7, this is probably the only one I wouldn't touch, is just look at how volatile this company is. It has clear, distinct peaks of when they reach a high, and then they go on a massive sell-off. And then they reach a peak, and then they go on a sell-off, a peak, and then a sell-off. So I said it before, like with NVIDIA, which is also kind of similar to Tesla in that they go on these peaks and sell-offs, because semiconductors inherently are a very cyclical space. Maybe it's not the worst idea in the world for me to buy into Tesla when they go on these massive sell-offs and then just wait for the inevitable rebound. Now, I'm gonna have to do my homework and research to see whether or not I wanna play with that, but that is what I'm seeing on the screen. Might not be a terrible idea, but I don't know if I can go ahead and say that Tesla is a buy and hold, because imagine if you bought into Tesla back in 2021 for about $407 a share. After roughly 4 years, you're barely in the green. So I just don't know if Tesla's a buy and hold, because a buy and hold for me is always gonna be going up and to the right, despite small pullbacks and corrections, little dips, but it's gonna continue to go up and to the right. It's similar to what we're seeing here with AutoZone. See, like there's inevitable sell-offs, but it always rebounds and it's continuously going up. Whereas with Tesla, dude, that's a very volatile ride that I don't have the stomach and the risk tolerance to just play with Tesla. I do sincerely apologize for going on that rant about Tesla in the car market. Now in this next segment, we're going to be talking about the scorecard and 4 metrics to give this portfolio, Carlos, right, what a handsome young man, his portfolio a grade and a rating. The first one is going to be the asset and strategy fit. Do the positions and holdings make sense for the goal of the portfolio, which is 10% year over year? I would argue based on what we saw, yes, it does for the most part. So I would say A-. It mirrors the performance of the broader market almost 1-for-1. They're pretty much doing the exact same thing at around the same time. And you might be like, why is it an A-? Because even though the goal might be to mirror the market, to be in that A+ or S tier, you gotta be edging it out and beating it by a decent change. So say like your CAGR is 10%, you should be getting at least 12 or 13%, then you're crushing it. But to emulate the market, not bad at all. A- is a really good rating. I think so many people out here hand out trophies and medals to everyone that we're delusional. I know I'm delulu, but we're so caught up with the idea that A- is bad. It's not, it's terrific. I think even for me, giving a C to a company is good. That means they're doing what they should be in line with the expectations, and it's average. A B, that's really good. An A, let alone an A-, dude, that's almost perfect. So A-, don't take it the wrong way, it's a good thing. And then the level of risk, going from 1, which is no risk at all, basically investing into a high yield savings account or a money market fund, and then a 10, where you YOLO all of your money into open door calls or puts, that's a 10. For this portfolio, I would go ahead and say it's a 3.5 out of 10. It's moderately safe, but I guess one could argue it's also moderately risky because the majority of the portfolio is in household blue chip big names, but it does have exposure to cyclicality stocks like ASML, Cheniere Energy, and then turnaround rebound plays like Disney and PayPal. Which is not to say that they're bad or low quality, but you have to understand that those stocks have been shaved off from their all-time highs by like 50, 60, 70%. So waiting for the inevitable turnaround that might never come, we have to associate some risk with that and bake it in. 3.5 though, I would argue, not bad at all. Anything less than 4 or 5, I think it weighs in my favor in terms of the risk to reward ratio. If you want to make a lot of money, you gotta bake in a little bit of risk. Because if I just put all of my cash into a high yield savings account, I'm lucky to get a 3.8, maybe a 3.9% ROI for that year. For me, friends and family, that's just not good enough. 10%, you gotta play with a little bit of the fire. I'm not talking about burning your whole body up, but you gotta play a little bit with the candle. And in terms of the quality of the holdings itself, I mean, I said it earlier, I genuinely like what I see in my own portfolio. I almost forgot. We have high quality stocks represented like Apple, Walmart, MasterCard, United Health, and Waste Management, the trash disposal and recycling company. But because of the turnaround bets like the PayPal and Disney, we do have to dock a whole letter grade. However, what's really funny is if I made this video back in like June or July, United Health would have been categorized into that risky turnaround bet. But dude, United Health is now categorized with the high quality compounders because they've rebounded from their lows of like $230 a share. I think they're roughly like $345. They're basically up by over $110 in like 3 months. That's why when people invest into rebound and turnaround stories and bets, I don't judge them too hard because if it works out for them, dude, that would be huge. But if it doesn't turn out for them, I guess it's a learning lesson in the stock market. And then for the last criteria, this is for portfolios that have some dividends incorporated into it. This one does. In terms of the dividend sustainability, reliability, do I see it being cut? I don't see any potential dividend cutter in here. I feel like every single one of the 16 stocks, if they do pay a dividend, I think Amazon does not, PayPal does not, and I think maybe one more doesn't, but everyone else that does pay the dividend, it should be safe. I looked at all of their financials, every single one of them should be okay. But if someone were to hold a hammer to my kneecap and was like, dude, you need to make some changes, otherwise I'm smashing your kneecap. Against that kind of scenario, This is what I would do instead of an extreme makeover and drastic plastic surgery. These are the modifications that I would make. What you see on the phone screen right now, so it's about pound for pound the exact same valuation as what it is currently, $37,000. So do you remember how in the beginning of the video I said one of the strategies of the portfolio is to minimize my bleeding whenever there's a market correction or a downturn where the economy is just trash? Well, friends and family, the current holdings itself, dude, this portfolio is going to be deep into the red if there's a recession. Because I think the only hedge that is represented to help kind of curve that is probably Waste Management, a trash utility company, because whether or not the times are good or bad, you're going to be paying for garbage disposal. But for stocks like Amazon, Apple, Google, even though we love them and we're familiar with them, if there is a bad economic downturn, those stocks are going to be shaved by like 40, 50, 60%. I'm not saying that as like a 100% forecast, but just historical data. And to hedge against the downturns, there's people out here that allocate money into like bond ETFs or into gold. But for me, I'm not really a part of that camp. So instead, because one of my portfolio goals is to reduce the red, I would allocate about 10 to 15% towards the utilities, maybe even like 20%. It really depends on your preference. I would increase the weighting towards the trash services, which in this case is Waste Management, and maybe even include a consumer staple like Procter & Gamble or Colgate-Palmolive. However, I think my base is covered there with Walmart because it doesn't matter who makes the shampoo, it's still going to be sold at Walmart, right? So I think Walmart covers that base right there. And since passive income is not really important for me, I would reconsider if realty income belongs in this family. Although if I were to do that, I would lose $261 in dividends per year. That would be pretty drastic and a huge blow to the overall portfolio's dividend yield. It would drop to like, 1%. Yield on cost with 1.4%. So having said all of that, if we take a look at the modified portfolio, there's currently 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and 11 holdings. So I did shave some of the ones that I'm not really in love with. And then I added American Water Works just to give some exposure to the utility space, because if you really do want to protect yourself in the downturn, the utility is a good proxy for that. I mean, you sacrifice a little upside, but in return, you get less sell-off. Not a fundamental truth, but as a general rule of nipple. So keeping in line with what I said, I didn't do drastic surgery, cutting off like all 16 shares and adding 16 new ones. I only added one new one. Instead of Realty Income Corporation being the biggest holding would now be Apple at 12.2% of the portfolio. And then we have United Health Group at 12% and then Amazon at 11.7%. So that would be the big three for me. And on the premise that I'm going to continue to invest about $833 a month or $416 every paycheck, then in about 10 years, the portfolio should grow from $37.6 thousand to $283,851. So not too bad with the current holdings, all things to remain the same. I think right now my vision is to sell PayPal once it rebounds, but if I don't sell PayPal and I just hold on to it, and if we do, 25 years, then I would be roughly 56 years old. I still think I'll be a young man. My portfolio would roughly be 1.7 million, which not bad at all. Going from 37,000 to 1.7 million, sign me right up. And if we jump on over to the dividends, with this modified portfolio, yes, our overall dividend payment is decreasing. It's going down from $651 to $572. And that's because our overall portfolio yield dropped from 1.73% to 1.52%. However, I think it's pretty interesting. Every month I can expect about $47. Good enough to probably pay for 1 or 2 meals eating out, and then every single day I would be paid $1.57. Not bad at all. And instead of Realty Income doing all of the heavy lifting, now I have PepsiCo. I think his dividend yield is roughly like 4.8, 4.9%. $153 per year in dividends from Pepsi. United Health would give $114. By the way, I got $82 in dividends from United Health today. I saw that in my brokerage account. I was like, woo, And if we scroll all the way down to the bottom, PayPal and Amazon, they don't pay a dividend. But if I were to make an educated guess, I could be wrong because I'm stupid, but I'm assuming that in the next 2 years or 700 days, I think Amazon is going to initiate a dividend. You heard it here. I'm saying it right now. PayPal, I truly don't understand why they don't pay a dividend. They've been around for a while. It's not like they're a new kid on the block. You're not a startup anymore, in my opinion. I think PayPal should be paying a dividend, and I think it would behoove of them to do so, because that would bring them into inclusion and make themselves more attractive as a stock, because there's so many dividend-paying ETFs and different indexes that want PayPal, but they can't because he doesn't pay a dividend. And I think PayPal could absolutely afford to pay a dividend because he has the financials, he has the fundamentals, he's profitable, he's good to go. It's just he's being stubborn and a little weird. So there you have it, folks. What do you think about my portfolio as Carlos? What adjustments would you make? What do you like about it? What ideas or takeaways do you have that you might implement in your own life? Let me know. Other than that, yesterday we went to the hospital. If you're not in the know, by the way, my wife, currently 36 weeks pregnant, expecting our first child. Gonna be a daughter, pretty excited. At the same time, super scared and nervous. Up until this point, it has been a very smooth pregnancy. Other than the occasional, cravings for like ice cream in the middle of the night, stuff like that. But I would argue nothing out of the ordinary. Up until yesterday's appointment, we did the ultrasound to see whether or not everything is still smooth sailing, and come to find out, baby girl is currently breached. I didn't even know what that is, right? So the doctor informed us that the baby is not upside down, because with about 3 to 4 weeks to go, the baby should be upside down. Like the head should be near the butthole area, and her head currently is still up here. And now we're categorized as a complicated pregnancy, because you can't deliver the baby feet first, because then the head can get stuck and it could be really a bad and devastating situation. So, come to find out, our two options right now. Number one, we're gonna do the ECV, which I don't even know what that is until yesterday. Essentially, they're gonna try to physically maneuver the baby inside the belly to turn her upside down. The success rate for that, I'm a numbers kind of guy. It's about a 40-50% success rate. And if it doesn't work out, while doing the maneuver, if the water breaks, she can go into labor right there and then. Most likely scenario is going to be a C-section. That was not on our bingo card for the pregnancy. The whole time we were expecting to go the whole natural route. But if things go south, could be a C-section birth. And we're supposed to be doing this next week. So next week, if I fall off the planet Earth and you don't hear from me and it's radio silence on this channel, I'm going to be doing dad duties. I'm going to be right there in the hospital room with her, make sure that mommy is doing okay. I'm going to be honest with you, it's a lot to take in. It's a lot of emotions, because I truly want to be optimistic and hope for the best, and that the ECV maneuver all works out, and then we can go on with the rest of the pregnancy and then deliver 3.5 weeks from now. But I'm also realistic as well, right? I think things could potentially go south, which means she will be induced into labor right there and then to save the baby, because apparently from the doctor's explanation, as they're turning the baby upside down, things could go south, as in the baby's heart rate could drop dramatically, as in they can accidentally pop her water, and then we have to induce labor right there and then. There's a lot of factors and variables where I'm kind of like, oof. So, not sure if you're spiritual or anything, but if you could keep my family in your prayers, that would mean a lot. And even if you don't, and you made it to this point in the video, thanks for hearing me out. I love you guys. Stay safe, good luck in the stock market, and I will talk to you really soon.